an overvalued dollar incentivizing imports, become more difficult to bear, and the pain inflicted on that portion of the economy increases. Eventually, in theory, a tipping point is reached at which such deficits grow large enough to induce credit risk in the reserve asset. The reserve country may lose reserve status, ushering in a wave of global instability. And this is referred to as the Triffin dilemma. Indeed, the paradox of being a reserve currency is that it leads to permanent twin deficits, which in turn lead over time to an unsustainable accumulation of public and foreign debt that eventually undermines the safety and reserve currency status of such large debtor economy. While the United States' share of global GDP halved from 40% of global GDP in the 1960s to 21% in 2012, and has recovered slightly to its present level of 26%, it is still far from such a tipping point, in part because there are no meaningful alternatives to the dollar or the USD. A reserve currency must be convertible into other currencies, and a reserve asset must be a stable store of value governed by reliable rule of law. While other nations, like China, aspire to reserve status, they satisfy neither of these criteria. And while Europe may, its bond markets are fragmented relative to the USD market, and its share of global GDP has shrunk even more than America's. It is worth observing that the US share of global GDP troughed around the GFC and has stabilized or improved since then, coincident with the pattern in manufacturing employment. In this telling, our share of global GDP drives the size of the Triffin distortion in trade equilibrium, which in turn drives the state of the tradable sector. The backdrop for these currency developments has been a system of tariff rates defining the international trading system that are, broadly speaking, locked into a configuration designed for a different economic age. According to the World Trade Organization, the United States' effective tariff on imports is the lowest any nation in the world imposes at about 3%, while the European Union imposes about 5% and China 10% point for these. Numbers are averages across all imports and not reflective of bilateral tariff rates. Bilateral discrepancies can be much larger. For instance, the US imposes only 2.5% tariffs on auto imports from the EU, while Europe imposes a 10% duty on American auto imports. 5 Many developing nations apply much higher rates, and Bangladesh has the world's highest effective rate, at 155%. These tariffs are, in large part, legacies of an era in which the United States wanted to generously open its markets to the rest of the world at advantageous terms, to assist with rebuilding after World War II, or in creating alliances during the Cold War. Moreover, tariffs in 3A critical analysis of the current account and fiscal aversions of the Triffin dilemma is available in Bordeaux and Macaulay, 2017. Their dismissal of these theories focuses more on the lack of dilemma or crisis in the near term, and the inability to identify any such crossing point, rather than on an ability to discount the basic mechanism. 4 https://www.wto.org/english/res_e/world_tariff_profiles 5 https://www.politico.com/news//2023/014/194/Joe-Mankin-Davos-inflation-reduction-act-Europe-0078510 7. A user's guide to restructuring the global trading system. Some cases enormously understate the unevenness of the playing field, as some nations employ material non-tariff barrows, steal intellectual property, and more. In theory, prior tariff rates may not affect trade if floating currencies adjust to offset them, but they have very significant consequences for revenue and burden sharing. See the discussion below. Figure 2 US share of global GDP. Source: World Bank. Economic consequences. While we are likely far from the economic crises that comprise the tipping point of the Triffin dilemma, we must nonetheless reckon with the consequences of the Triffin world. Reserve nation status comes with 3 major consequences: somewhat cheaper borrowing, more expensive currency, and the ability to pursue security goals via the financial system. 1. Cheaper borrowing. Because there is a persistent reserve-driven demand for USD securities, the United States may be able to borrow at lower yields than would otherwise be the case. Because economists have little variation to study, we've been the sole reserve currency for many decades, it's impossible to have confidence about how big this benefit is. Some estimates, fictional as they are, have it as large as 50 to 60 basis points of borrowing yield. McKinsey, 2009. In any case, there are numerous countries that borrow significantly more cheaply than the United States. At the time of writing, all G7 members borrow more cheaply than the United States except for the UK, which borrows a tenth of a percent more expensive. Other peers like Switzerland and Sweden borrow more cheaply too, Switzerland by almost 4 percentage points. Meanwhile, an erstwhile troubled debtor like Greece can borrow over a point more cheaply. 8. A user's guide to restructuring the global trading system. More precisely, one can create a synthetic dollar borrowing rate with currency risk hedged out, i.e. examine deviations from covered interest parity, as in Du, Im, and Schreger, 2018. Such deviations are currently, and usually, close to 0.6 for the United States relative to other G10 borrowers. In other words, there's little special borrowing rate conferred on the US relative to other developed countries. G10 vs. EM, however, still contain substantial residuals, suggesting that emerging markets pay a borrowing premium relative to developed markets to borrow. The inference I draw from this is that while, all else equal, being a reserve currency may reduce borrowing costs, whatever benefit is gained is likely to be dwarfed by things like central bank policy outlooks, growth and inflation forecasts, and equity market performance. However, the borrowing advantage may be framed differently. Rather than reducing the cost of borrowing, it may reduce the price sensitivity of borrowing. In other words, we don't necessarily borrow substantially cheaper, but we can borrow more without pushing yields higher. This is a consequence of the price inelasticity of demand for reserve assets, and the flip side that we run large external deficits to finance that reserve provision. 2. Richer currency. The more significant macroeconomic consequence of serving as their world's reserve producer is that reserve demand for American assets pushes up the dollar, leading it to levels far in excess of what would balance international trade over the long run. According to the IMF, there are about $12 trillion of global foreign exchange reserves in official hands, of which roughly 60% are allocated in dollars. In reality, reserve holdings of the dollar are much higher, as quasi and non-official entities hold dollar assets for reserve purposes too. Clearly, $7 trillion of demand is enough to move the needle in any market, even currency markets. For reference, $7 trillion is roughly a third of US M2 money supply. Flows creating or unwinding these holdings will obviously have significant market consequences. If trillions of dollars of securities bought for the Fed's policy and not investment purposes on the Fed's balance sheet have had any effect on financial markets, then trillions of dollars bought for foreign central banks' policies and not investing purposes should also have some effect if they are on other nations' balance sheets instead of the Fed's. Because nations accumulate reserves in part to stem appreciation. Canada 1.05, Japan 3.38, UK 0.12, France 1.19, Germany 1.94, Italy 0.66, Greece 1.03, Switzerland 3.93, Sweden 2.20. Table 1. 10-year borrowing spreads to Treasury notes. Negative numbers mean the other nation borrows more cheaply than the United States. Source: Bloomberg, HBC calculations. Pressures in their own currencies, there is a contemporaneous negative correlation between the exchange value of the dollar and the level of global reserves. Reserves tend to go up when the dollar is going down, as accumulators buy dollars to suppress their currencies, and vice versa when the dollar is going up. Nevertheless, other than 2 quarters in 1991, the United States has run a current account deficit since 1982. That the current account cannot balance beyond a negligible period over half a century tells us the dollar is not playing its role of equilibrating international trade and income flows. The interplay between reserve status and the loss of manufacturing jobs is sharpest during economic downturns. Because the reserve asset is a safe, the dollar appreciates during recessions. By contrast, other nations' currencies tend to depreciate when they go through an economic downturn. That means that when aggregate demand suffers a decline, pain in export sectors get compounded by a sharp erosion of competitiveness. Thus employment in manufacturing declines steeply during a recession in the United States, and then fails to recover materially afterward. 6 https://google.com/view/JSCA treasure/CIP ? Orthesor equals 0. 9. A user's guide to restructuring the global trading system. Current account. Current account, percent GDP. 2. 1. 012345678. 30. 15153045607590105. 2020 2024 2010 2000 199019801970 1960 1950 1961 to 120. Figure 3 U.S. current account. Source: Bureau of Economic Analysis, HBC calculations. Current account: billions of dollars. It may seem odd to suppose that reserve demand for Treasury securities plays only a small role in delivering favorable borrowing terms, yet a large role in creating currency overvaluation. However, that is the explanation most consistent with outcomes in both interest rate markets and the balance of payments. Indeed, it is also consistent with the idea that liquidity injections ultimately raise interest rates because they stimulate stronger nominal growth. Other theoretical explanations for this combination of outcomes could make interesting research. 3. Financial extraterritoriality. Finally, if the reserve asset is the lifeblood of the global trade and financial systems, it means that whoever controls the reserve asset and currency can exert some level of control trade and financial transactions. That allows America to exert its will in foreign and security policy using financial force instead of kinetic force. America can, and does, sanction people all over the globe in a variety of ways. From freezing assets to cutting nations off. From swift and restricting access to the US banking and financial system that is critical for any foreign bank. Doing global business, the US exerts its financial might to achieve foreign policy ends of weakening enemies, without having to mobilize a single soldier. Economists cannot evaluate whether America's national security goals are worthy, only note that it can achieve them far more cheaply because of America's control of the international trade and financial systems by virtue of our reserve currency status. A comprehensive review of how the United States mobilizes the global financial architecture for national security purposes is given in Cipriani, Goldberg, and Lars Botter, 2023, and a history of many of the key players in Mosine. 2024. In a broader sense, sanctions can also be perceived as a modern-day form of a blockade. Many previous reserve-providing nations possessed significant sea power by virtue of their trading empires, which allowed them 10. A user's guide to restructuring the global trading system. To blockade rival nations and hamper their economic production, sanctions achieve related outcomes without their need for physical action. The core trade-off. Synthesizing these properties of reserve assets, if there is persistent Synthesizing these properties of reserve assets, if there is persistent, price inelastic demand for reserve assets, but only modestly cheaper borrowing, then America's status as reserve currency confers the burden of an over-valued currency eroding the competitiveness of our export sector, balanced against the geopolitical advantages of achieving core national security aims at minimal cost via financial extraterritoriality. The trade-off is thus between export competitiveness and financial power projection. Because power projection is inextricable from the global security order America underwrites, we need to understand the question of reserve status as intertwined with national security. America provides a global defense shield to liberal democracies, and in exchange, America receives the benefits of reserve status, and, as we are grappling with today, the burdens. This connection helps explain why President Trump views other nations as taking advantage of America in both defense and trade simultaneously. The defense umbrella and our trade deficits are linked through the currency. In a driven world, this arrangement becomes more challenging as the United States shrinks as a share of global GDP and military might. As the economic burdens on America grow with global GDP outpacing American GDP, America finds it more difficult to underwrite global security because the current account deficit grows and our ability to produce equipment becomes hollowed out. The growing international deficit is a problem because of the increased strain it places on the American export sector and the socio-economic problems that follow therefrom. That their bargain becomes less appealing in this context brings us to present, whereby there is growing consensus in America to change the relationship, reshaping the global system. If America is unwilling to bear the status quo, then it will take steps to change it. There are, broadly speaking, unilateral and multilateral approaches, and approaches focused on tariffs or currencies. Unilateral solutions are more likely to have undesired side effects, like market volatility. Multilateral solutions may have less volatility, but entail the difficulty of getting trading partners on board, which curtails the size of the potential gains from reshaping the system. Unilateral policies provide greater flexibility to rapidly shift policy. Multilateral policies are more difficult, maybe impossible, to implement, but allow you to recruit foreign policymakers to help reduce volatility. The US dollar is the reserve asset in large part because America provides stability, liquidity, market depth, and their rule of law. Those are related to the characteristics that make America powerful enough to project physical force worldwide and allow it to shape and defend the global international order. The history of intertwinement between reserve currency status and national security is long. In any possible reshaping of the global trading system, these linkages will become ever more explicit. Both tariffs and currency policy are aimed at improving the competitiveness of American manufacturing, and thus increasing our industrial plant and allocating aggregate demand and jobs from the rest of the world stateside. These policies are unlikely to result in significant reshoring of low-value-added industries like textiles, for which other countries, like Bangladesh, will retain comparative advantage despite significant swings in currency or tariff rates. However, these policies can help preserve the American edge in high-value-added manufacturing, slow down and prevent further offshoring, and potentially increase negotiating leverage with which to procure agreements from other countries to open their markets to American exports or protect American intellectual property rights. The Phase 1 trade deal with China in 2019 made advances in these domains, before China abdicated its commitments under that agreement. 11. A user's guide to restructuring the global trading system. Moreover, because many in the Trump camp see trade policy and national security as inextricably intertwined, many interventions will be targeted at industrial plant critical to security, to the extent they can. National security will likely become ever more broadly conceived, for instance to include products like semiconductors and pharmaceuticals. Despite the dollar's role in weighing heavily on the US manufacturing sector, President Trump has emphasized the value he places on its status as the global reserve currency, and threatened to punish countries that move away from the dollar. I expect this tension to be resolved by policies that aim to preserve the status of the dollar, but improve burden sharing with our trading partners. International trade policy will attempt to recapture some of the benefit our reserve provision conveys to trading partners and connect this economic burden sharing with defense burden sharing. Although the Triffin effects have weighed on the manufacturing sector, there will be attempts to improve America's position within the system without destroying the system. No matter what policy is adopted, there is the risk of material adverse consequences for financial markets and their economy. However, there are steps the administration can take to try to mitigate these consequences and make the policy changes as successful as possible. 12. A user's guide to restructuring the global trading system. Chapter 3. Tariffs. Tariffs are a familiar tool to President Trump and his team, since they were used, with success, extensively in 2018-2019 in trade negotiations with China. Those tariffs passed with little discernible macroeconomic consequence. Inflation remained stable or even declined, and GDP growth continued to perform quite well despite the Fed's hiking cycle. It is therefore reasonable to expect tariffs once again to be a primary tool. Tariffs and currency offset. Before discussing how unilateral and multilateral tariff regimes might work in practice, I first review some economics of tariffs. There are several critical dimensions to study: inflation, incidence, and efficiency, including how tariffs compare to other types of taxes. In the analysis that follows, the critical question is to what extent currencies adjust to offset changes in international tax regimes. A recent rigorous theoretical treatment and literature review is given, for instance, in Jean and John, 2024. The classic reason currencies offset changes in tariffs is that tariffs improve the trade balance, which then puts upward pressure on the currency for traditional reasons. But currencies might also adjust because nation central banks adjust interest rates to offset inflation and demand changes, or because end supply is determined by comparative advantage and end demand by preferences, and currencies adjust to offset changes like taxes, or because the growth prospects of the tariffing country improve relative to the tariffed country, attracting investment flows, so long as tariffs do not exceed optimal levels, see below. To illustrate the mechanism simply, let Px be the price of a good charged by foreign exporters, denominated in their own currency, e the exchange rate, dollars per foreign currency unit, and tau the tariff rate. Then the price paid by American importers is PM equals E, 1 plus TO, PX. Suppose we begin with E equals 1 and TO equals 0. The government imposes a 10% duty on imports, but the foreign currency depreciates by 10% as well. Then the price paid by importers becomes PM equals 0.9, 1.1, PX equals 0.99 PX. In other words, the exchange rate move and the tariff almost completely offset each other. 0.7 The after-tariff price of the import, denominated in dollars, didn't change. If the after-tariff import price in dollars doesn't change, there are minimal inflationary consequences for the American economy, but not so for the exporting country. Now, underlying this simple example are a number of assumptions which must be made clear. 1. The exchange rate must move by the right amount. 2. Primitive and intermediate value added in final exports originate predominantly in the exporting nation. 3. Pass-through from exchange rates to exporter prices PX is complete. Importantly, since imports are often inversed in USD, the exchange rate doesn't automatically affect. Instead, a strengthening in the dollar improves exporter profit margins if exchange rates do not pass through into prices. 4. Pass-through from wholesale import to retail consumer prices is complete. As I will discuss below, these assumptions may not hold perfectly, in which case there is room for more volatility in prices, international trade, and markets. Further, to the extent there are no meaningful changes to, then there will be no rebalancing of trade flows as a result of the tariffs. If imports from the tariffed nation become more expensive, then there will be some rebalancing of trade flows but also higher prices, if imports from the tariffed 7 technically, he has to adjust by 1 plus TO, to perfectly offset the tariff, or in this case 9.09%. 13. A user's guide to restructuring the global trading system. Nation do not become more expensive because of currency offset, then there's no incentive to find cheaper imports. One must choose between higher prices and rebalancing trade. Revenue is an important part of this story, as discussed below. Inflation. While in principle tariffs can be non-inflationary, how likely is it? In the macroeconomic data from the 2018 to 2019 experience, the tariffs operated pretty much as described above. The effective tariff rate on Chinese imports increased by 17.9 percentage points from the start of the trade war in 2018 to the maximum tariff rate in 2019. See Brown, 2023. As the financial markets digested the news, the Chinese renminbi depreciated against the dollar over this period by 13.7%, so that the after-tariff USD import price rose by 4.1%. In other words, the currency move offset more than 3/4 of the tariff, explaining the negligible upward pressure on inflation. Measured from currency peak to trough, who knows exactly when the market begins to price in news? The move in the currency was 15%, suggesting even more offset. Measured CPI inflation moved from slightly above 2% before the start of the trade war to roughly 2% by their armistice. Measured PCE inflation went from slightly below the Fed's target to further below the Fed's target. Of course, there were cross-currents like the Fed's tightening cycle at the time, but any inflation from this trade war was small enough that it was overwhelmed by these cross-currents. This explains the Trump camp's view that their first US-China trade war was non-inflationary. While the macroeconomic data appear consistent with the currency offset theory, academics studying goods level microdata take a harsher view of this experience. For instance, Kavorlo, Gopinath, Neiman, and Zhang, 2021. Study detailed microdata of goods imported by retailers and find that the dollar import price moved up by their amount of the tariff, and that the appreciation of the dollar did little to offset the tariffs. In other words, they argue difference in trade tariff and after-tariff USD import price 2018 to 1. 20. 15. 10. 5. 0 to 5. JA. AP. Jew. OC. JA. AP. Jew. SE. 2018 201. Figure 4 changes in effective tariff rates and currency offset. Source, Brown, 2023, Federal Reserve, Author's Calculations. 14. A user's guide to restructuring the global trading system. Figure 5 core CPI and PCE inflation, annual rates. Source, BLS, BA. That the move in the currency didn't pass through into import prices. 8 similar conclusions are drawn by Fagelbaum et al., 2020, and Amiti, Redding, and Weinstein, 2019. What can bridge the gap between the macrodata arithmetic and the results of microdata studies? First, examples. Like Cavorlo et al. Tend to study short-run effects, and it is possible currency pass-through into prices will be much slower than tariff pass-through. It's much less salient, and importers tend to hedge their currency exposures anywhere from a few months to a few years out. If the importers hedge currency risk, it will take time for level shifts in the currency to pass through into inversed prices. It would be bizarre for any economist to think that pass-through will never occur, since a competitive marketplace will result in producers lowering prices to marginal cost. If economists began to believe currencies didn't affect the prices of traded goods, they'd have to reimagine several branches of economics. Amiti et al., 2018, refer to the lack of exchange rate pass-through as a puzzle and speculate that over a longer period, exchange rate effects will materialize. Second, Cavorlo et al. Find that the price hikes occurred for prices paid by importers, not prices sold by retailers, limiting the ability of tariffs to result in increases in consumer prices but squeezing margins. That means that for the measures of inflation commonly prioritized, like the Consumer Price Index or the Price Index for personal consumption expenditures, there was little consequence. That helps reconcile the micro and macro experiences. However, it would be bizarre for economies with sufficient competition not to see importers over time restore their margins by shifting suppliers if currency weakness isn't passed through. Third, interpreting goods-level microdata is difficult in light of re-export diversion. To avoid the tariffs, many Chinese companies began exporting goods or components to third countries, engaging in some minor processing, and then re-exporting to the United States. Ioher et al., 2024, find that rerouting of Chinese imports increased by roughly 50% since the tariff increases. And Freeman, Baldwin, and Theodorakopoulos, 2023, find that, while just 8 more formally, because imports are inversed in USD, the currency move doesn't automatically affect the import price. If imports are inversed in USD and the dollar appreciates, foreign profit margins improve, and then over time competition should whittle that margin so that then the dollar-inversed import price declines. 15. A user's guide to restructuring the global trading system. Over 60% of manufacturing intermediates imported into the US came directly from China, incorporating their value added of manufacturing intermediates that originated in China but were imported from other trade partners brought that number above 90%. The decision for Chinese exporters whether to evade tariffs via re-export is affected by the demand elasticity for their exports in the United States, introducing a critical bias into microdata studies. It is likely that the goods that are still directly exported to the US and therefore subject to the tariffs are the ones over which the Chinese exporters retain the most pricing power and the greatest ability to pass through price increases on Americans. The goods on which Chinese exporters do not have pricing power, and over which they might have to absorb the tariffs, are their ones most likely to be re-exported via a third country. Chinese exporters will not pay the cost of diverting exports if they can push through price increases on purchasers. This practice severely upwardly biases the results of their microdata studies. Only those goods with the highest ability to foist increases on Americans continue to be labeled as a made in China, and other goods receive minor processing elsewhere and get labeled as different origin. In other words, difference in difference and related approaches will overestimate the effect of tariffs on prices in microdata. Nevertheless, let's consider the results in Cavorlo et al. At face value, and suppose America puts a 10% tariff on all imports, per President Trump's proposals. With complete pass-through, that would lead to a 10% increase in prices of imported goods in the United States. Further, suppose the dollar behaves as in 2018 to 19 and appreciates by their same amount as the tariff, 10% on a broad basis. Gopinath, 2015, estimates that USD pass-through to imported prices is about 45% in the first 2 years, and that a 10% move in the USD impacts CPI by 40 to 70 basis points. Gopinath, 2015, calculates that 6% to 12% of all consumption derives from imported sources, while Briggs, 2022, estimates that number at about 10%. With 10% of consumption from imported sources, 100% pass-through, and a 10% tariff, consumer prices will go up by 1 percentage point. Incorporating the 40 to 70 basis point drag on inflation from the stronger dollar would indicate a total tariff pass-through into price levels of 0.3% to 0.6% of the CPI. All else equal and in a calm economic environment, such a modest increase would be a one-time boost to the price level and thus transitory, rather than contribute to lasting inflation. In more turbulent times and greater inflationary crosscurrents, such a change may work its way into inflation expectations and become more persistent, contributing to a goods-wage inflationary spiral. The economic context into which tariffs are levered will be of significant importance, and the fragility or robustness of inflation expectations and local supply elasticities at current macroeconomic equilibrium can play substantial roles. Certainly, there was no indication in 2018 to 2019 of a goods-wage spiral. If the currency markets adjust, tariffs can have quite modest inflationary impacts, between 0% and 0.6% on consumer prices. Given the inflation volatility of recent years, this is non-trivial, but hardly earth-shaking. Clearly, the experience of 2018 to 2019 was that there were only imperceptible increases on the general price level. Moreover, the totality of tax reform, deregulation, and energy abundance can serve as meaningful disinflation drivers that smother any incipient inflationary impulses. It is quite possible that even with substantial tariffs, Trump administration policy is overall disinflationary. I will later turn to the likelihood of whether currency markets will adjust, as well as to the risks of retaliation, which can alter the tariff analysis, incidence, revenue, and trade flows. Like inflation, the question of who bears the burden of the tariff will depend on what prices adjust, but there are more nuances. In a world of perfect currency offset, the effective price of imported goods doesn't change. But since the exporter's currency weakens, its real wealth and purchasing power decline. American consumers' purchasing power isn't affected, since the tariff and the currency move cancel each other out, but since their exporter citizens became poorer as a result of the currency move, the exporting nation pays for or bears their burden of the tax, while the U.S. Treasury collects the revenue. 16. A user's guide to restructuring the global trading system. While the effective price paid by U.S. importers may not change very much with perfect currency offset, U.S. exporters now face a competitiveness challenge insofar as the dollar has become more costly for foreign importers. Presumably, they have hedged most of their currency exposures, and this can help lessen that pain in the short run. Thus, there is a trade-off. If currencies perfectly adjust, the U.S. government collects revenue in a non-inflationary way paid by foreigners via reduced purchasing power, but exports may become encumbered. Policymakers can in part alleviate any drag on exports by an aggressive deregulatory agenda, which helps make U.S. production more competitive. Recent work by Goldbeck, 2024, flags the increase in regulatory-related compliance under the Biden administration as costing the economy over 1% of GDP per year, while research from LePerrier et al., 2024, suggests those costs could be twice as large. Improvements in competitiveness driven by regulatory reform can offset drags on competitiveness due to currency appreciation. By contrast, if currency offset does not occur, American consumers will suffer higher prices, and the tariff will be borne by them. Higher prices will, over time, incentivize a reconfiguration of supply chains. American producers will have improved competitiveness selling into the American market, and importers will be incentivized to find alternatives to the tariffed imports. As trade flows adjust, the trade balance can decline, but then the tariffs will no longer collect much revenue. These trade-offs are listed in Table 2, though of course reality may fall in between these extremes. Perfect currency offset. Inflation. Non-inflationary, after tariff USD. Price unchanged. Incidence. Trade flows. Revenue. Paid for by tariffed nation via reduced purchasing power from weaker currency. Little effect on trade flows, as effective. Import prices don't increase and regulatory reform offsets currency. Effects on exports. Treasury raises revenue. Table 2, comparison of outcomes under total and no currency offset of tariffs. No currency offset. Inflationary, tariff passed through. Result in more expensive consumer goods. Rebalancing over time as imports are more expensive relative to domestic production. As trade rebalancing away from their tariffed goods occur, Treasury raises less revenue. Once again, there is a disconnect between the macro experience and studies of the microdata on questions of incidence. However, note that in Cavorlo et al., 2021, the microdata indicate the price hikes occurred for prices paid by importers, and that those prices were not passed through to retailers. In other words, the incidence fell on reduced retailer profit margins, rather than consumers themselves. This helps further bridge the gap between their microdata and the macro experience in price data. The same questions about the microdata studies pertain to the finding of reduced wholesaler margins as well. Primarily that this is a short-term effect, and that in the long run changes to wholesaler profitability will lead to other changes that will end up passing through the cost. Over time, wholesalers will find ways to source products more cheaply. Moreover, this result implies that profitability was enhanced for Chinese exporters, since they experienced both currency depreciation and pass-through of tariff costs to retailers. Over time, competition among them will lead to reduced profitability, or rebalancing of trade flows to other exporters or domestic producers. 17. A user's guide to restructuring the global trading system. Currency offset and financial markets. While reducing volatility in consumer prices, currency offset can actually imply greater and not less volatility in financial markets, at least in the short term. For instance, the volatility of early August was deeply intertwined with moves in the Japanese yen. Carry traders borrowing in yen to buy higher yielding assets in other currencies were highly levered, and the assets they were long were also held by other types of highly levered investors. When their carry trade began to unwind somewhat, due to a shift in the stance of the Bank of Japan and an increase in their unemployment rate in the United States, the long assets were sold by levered traders managing their risk exposures. The result was significant financial market volatility, in which the Nasdaq Composite Index fell 8% in 3 sessions. USD JPY. Nasdaq Composite. Nasdaq Composite and US dollar to Japanese yen. 0. 15,000. 16,000. 17,000. 18,000. 19,000. 0. 125. 135. 145. 155. 165. June, July, August, April, May, March. 2024. Figure 6. During the flash crash of early August, the correlation between the yen and stocks was near complete. Source: Bloomberg. Similarly, imagine a very large tariff on China, say a sharp increase in the effective tariff rate from roughly 20% to roughly 50%, offset by a similar move in the currency. A 30% devaluation in the renminbi would most likely lead to significant market volatility. Because China's communist economic system necessitates strict control over their capital account to keep funds locked in domestic assets, the incentives to find ways around capital controls could be devastating for their economy. Capital outflows from China can potentially result in asset price collapses and severe financial stress. According to Bloomberg, total debt in the Chinese economy exceeds 350% of GDP. Figure 7. This level of leverage entails the possibility for massive vulnerabilities to leakages in the capital account. Bursting bubbles in China as a re. 18. A user's guide to restructuring the global trading system. Salt of currency devaluation could cause financial market volatility significantly in excess of that caused by their tariffs themselves. Financial market volatility from currency moves may far exceed the volatility from total pass-through of tariffs into consumer prices. For example, consider the case of total pass-through of a 10% tariff that boosts consumer prices by 1% with no currency offset. Such a move is a one-time shift in the price level, not a persistent increase in their inflation rate, and may therefore be ignored by the central bank, in which case there are not likely to be much in their way of financial fireworks. If the central bank fears second-round effects taking hold, it may hike rates, say, by 75 basis points, half of what it would if it considered a persistent 1-point increase in the inflation rate. Such an adjust meant to monetary policy will likely induce less volatility than a 10% move in currency markets. It's worth noting that value-added taxes are a form of tariffs because they exempt exported goods but tax imported goods, and central banks usually do not respond to them, because legislated price changes are typically thought not to be indicative of underlying supply-demand imbalances. Indeed, the fact that other countries have VATs and we do not says something about initial conditions. Even without a currency or monetary response, tariffs can affect profitability. For instance, Amiti et al., 2021. Estimate that firms more exposed to tariffs experienced steeper declines in equity value in the days following tariff announcement. There are a few problems taking these results at face value. However, many of these estimates are statistically insignificant from zero effect, and markets are prone to excess volatility. What matters is whether there is a lasting effect from the tariffs, and as any investor knows, initial market responses often unwind or reverse over time. China total economy debt, percent GDP. 400. 300. 200. China total economy debt, percent GDP. 100. 0. 200. 200. 200. 201. 201. Figure 7 excessive levels of debt in the Chinese economy. Source, Bloomberg. 201. 201. 201. 202. 202. 19. A user's guide to restructuring the global trading system. How likely is currency offset to occur? The economic and market consequences of tariffs hinge on the extent to which they are matched by offsetting changes in currencies, so it is important to consider the likelihood that currencies do adjust. In the US-China trade war of 2018 to 2019, currency offset was effective. However, there were several crosscurrents at the time that make the comparison cloudy. For instance, the dollar was appreciating more broadly than just vs. China, during the period discussed above, the DXY dollar index maintained by the Intercontinental Exchange, which measures the dollar against other developed nations, also increased by about 10%. As mentioned above, currency moves in one pair can affect other assets too, just as an unwind in the yen carry trade affected all financial markets. Indeed, given the significance of the USD-RMB pair to their global economy and markets, it is possible a good portion of the move in DXY was driven by the move in USD-RMB. Such a possibility is bolstered by trends in interest rates over the period. The most powerful financial variable for explaining currency moves in developed markets is typically the spread in interest rates at the front end of their yield curve. Market participants usually use T-year yields, but the convention varies depending on the interest rate and economic environment. In the period of the trade war, the yield advantage of UST securities was declining. Relative to the yields on other G7 debt, the spread declined from about 2% in January 2018 to about 1.65% at their trade war armistice in September 2019. The decline in spreads occurred despite the rate hikes from the Federal Reserve over the course of 2018. This happened because markets marked down their expectations for future rate hikes as the economic data came in over the course of 2018. Of course, currency markets would typically follow changes in expected policy rather than the already priced-in policy hikes occurring in real time. A fully expected change in policy should have no effect on currency markets. Thus, it is highly unlikely the dollar appreciated because of monetary policy during this period. It appreciated in spite of monetary policy. 2-year yield spread vs. FX. USD2s, G7 average. Dollar index, DM. 90, 91, 92, 89, 95, 96, 100, 1.5, 1.6, 1.4, 2.0, 2.1, 2.2, 2.3, 2.4, 2.5, 0, 0. June, October, April, Jan, June, Sep, April, Jan. 2018, 2019. 1.7, 1.8, 1.9, 93, 94, 97, 98, 9. Figure $8 index vs. The spread on sovereign US T-year debt relative to the average on T-year debt for other G7 nations. Source: Bloomberg. 20. A user's guide to restructuring the global trading system. In 2025 to 2026, the yield spread of Treasury securities over other nations' debt may narrow if the Fed continues its cutting cycle, catching up to other central banks and the special factors boosting US growth, like fiscal policy. Further fade and US growth converges down to the rest of the world's. A declining yield environment might make it more difficult for the dollar to rally to offset tariff hikes, although the experience of 2018 to 2019 shows currencies can move against interest rate differentials. In 203,310. Alternatively, concerns over US debt sustainability may come to the fore and prevent the dollar from appreciating to offset tariffs. The US deficit for last fiscal year and this fiscal year are both near 7% of GDP 9, during a peacetime expansion, an unprecedented degree of fiscal laxity. And with the Social Security Trust Fund set to run out of money. At which time the government will likely be forced to borrow to pay mandatory expenditures, budget woes draw inexorably nearer. Since currencies always trade relative to each other, markets would have to become inordinately preoccupied with US budget problems for this to prevent a rise in the dollar. Given many other nations' precipitous demographic trends, they have severe budget problems lurking in their futures as well, even if their primary deficits are not projected to rise as much. Moreover, because tariffs raise revenue, deficit concerns are likely to be allayed by hikes in tariff rates, suggesting this is an unlikely channel to prevent appreciation. A further reason the dollar might not appreciate as in 2018 to 2019 is if it starts from stronger levels. In 2018, the DXY index was at the bottom of its post-2014 range. At writing, it is in the middle of that range. This would be more of a concern if the DXY was stretched near the top of its long-term range. Finally, the dollar will be cross-buffeted by cyclical and secular changes to growth. There may be other changes which weigh on economic growth and prevent dollar appreciation. By contrast, former President Trump has expressed a desire to take steps to aggressively deregulate portions of the economy. If doing so serves as a boost to growth, it may provide further non-inflationary support for the dollar. Summing this all up, it is of course possible that currency offset does not occur in the next iteration of tariffs, but considering plausible reasons why that might be the case, offset seems more likely than not. Tariff implementation. A sudden shock to tariff rates of the size proposed can result in financial market volatility. That volatility can take place either through elevated uncertainty, higher inflation, and the interest rates required to neutralize it, or via a stronger currency and knock-on effects thereof. President Trump, and those likely to staff his economic policy team, have a history of caring deeply about financial markets and citing the stock market as evidence of economic strength and the popularity of his policies. A second Trump administration is likely therefore take steps to ensure large structural changes to the international tax code occur in ways that are minimally disruptive to markets and the economy. There are several steps that would help mitigate any adverse consequences. Graduated implementation. Even in the 2018 to 2019 trade war, President Trump didn't implement 25% tariffs on Chinese imports in one swoop. With no warning. He discussed these plans publicly and threatened China if it didn't reform its trade practices before implementing tariffs. Subsequent to open threats, they were implemented in such a manner that the roughly 18-point increase in effective tariff rates was spread over more than a year. 9. To consider its effects on aggregate demand, supply, and markets, last year's deficit has to be adjusted to offset accounting technicalities surrounding the Biden administration's failed attempts to forgive student loans, c. https://www.cbo.government/publication/59544. 10 https://www.ssa.government/oact/trsum/index.html. 21. A user's guide to restructuring the global trading system. In going to 60% tariffs on China or 10% globally, such an approach becomes even more important. During his first administration, President Trump sought to use tariffs to procure a trade agreement from China, which ultimately found shape in the Phase 1E agreement, a commitment to improve practices on intellectual property, cybersecurity, non-tariff barrows, openness to financial services, and purchases of agricultural commodities. That was subsequently violated and disregarded by China. Because tariffs are a negotiating tool, the president was mercurial in their implementation. The uncertainty over whether, when, and how big adds to leverage in a negotiation by creating fear and doubt. In a second term, there's less cause to negotiate with the Chinese upfront, since they already abdicated their responsibilities under the Phase 1 agreement. When someone has already demonstrated they walk away from their commitments, why bother trying to procure more without some form of security, like placing their UST reserves in escrow? Instead, to help minimize uncertainty and any adverse consequences of tariffs, the administration can use credible forward guidance, similar to what is used by the Federal Reserve across a range of policies, to guide expectations. The US government might announce a list of demands from Chinese policy, say, opening particular markets to American companies, an end to or reparations for intellectual property theft, purchases of agricultural commodities, currency appreciation, or more. The US can proceed to gradually implement tariffs if China does not meet these demands. It might announce a schedule, for instance, a 2% monthly increase in tariffs on China, in perpetuity, until the demands are met. Such a policy will 1. Gradually ramp tariffs at a pace not too different from 2018 to 2019, which the economy seemed able to easily absorb. 2. Put the ball in China's court for reforming their economic system. 3. Allow tariffs to exceed 60% midway through the term, which is something President Trump has expressed wanting, as 60% is a starting point. 4. Provide firms with clarity over the path for tariffs, which will help them make plans to deal with supply chain adjustments and moving production outside of China. 5. Limit financial market volatility by removing uncertainty regarding implementation. 2018 to 2019 did not severely hobble China's economy and bring back all its supply chains to the United States. In part, this is because it was a one-time shock to tariff rates, which was mostly offset by the currency. By contrast, a plan like the one set forth above would result in a perpetually rising tariff rate on a known and gradual path. That would likely instill much greater capital pressures on China and more rearrangement of supply chains. Point 11. And with significant pressure on China, it is likely to achieve greater trade concessions. Critically, in the wake of their abdication of Phase 1 commitments, Chinese obligations under trade agreements should now be secured rather than unsecured. Graduated scales, leverage, and security. The last trade war saw gradations of tariff rates for different types of products imported from China. It is likely that the next Trump administration take a similar approach with respect to both products and trading partners. While President Trump has proposed a 10% tariff on the world as a whole, such a tariff is unlikely to be uniform across countries. Scott Bessent, a Trump advisor floated as potential Treasury Secretary, has proposed putting countries into different groups based on their currency policies, the terms of bilateral trade agreements and security agreements, their values, and more. Per Bessent, 2024, these buckets can bear different tariff rates, and the government can lay out what actions a trade partner would need to undertake to move between the buckets. 11. Of course, supply chains might have ultimately had greater adjustments if the Phase 1 deal reached in the fall of 2019 had been enforced. Given China abandoned it as soon as the Biden administration took over, and the Biden administration had no interest in trying to enforce it, it is unclear if the trade war of 2018 to 2019 would have had more lasting consequences. 22. A user's guide to restructuring the global trading system. In this manner, tariffs create negotiating leverage for incentivizing better terms from the rest of the world on both trade and security terms. America would encourage other nations to move to lower tariff tiers, improving burden sharing. One can imagine a long list of trade and security criteria, which might lead to higher or lower tariffs, premised on the notion that access to the US consumer market is a privilege that must be earned, not a right. For example, Maybe the US wants to discriminate based on: does the nation apply similar tariff rates to their imports from the US as America does on their exports here? Does the nation have a history of suppressing its currency, for instance via the accumulation of excessive quantities of foreign exchange reserves? Does the nation open its markets to US firms in the same way America opens its markets to foreign firms operating stateside? Does the nation respect American intellectual property rights? Does the nation help China evade tariffs via re-export? Does the nation pay its NATO obligations in full? Does the nation side with China, Russia, and Iran in key international disputes, for instance at the United Nations? Does the nation help sanctioned entities evade sanctions, or trade with sanctioned entities? Does the nation support or oppose US security efforts in various theaters? Does the nation harbor enemies of the United States, e.g. terrorists or cybercriminals? Do the nation's leaders grandstand against the United States in the international theater? Because of the concern of the impacts of such a system on global markets, a Trump administration may want to pursue a rate phase-in approach as described above, starting with low tariffs and only hitting the maximum 10% rate over time. Moreover, such a system is likely to begin with a small number of criteria as it is tested out, and then the criteria can grow in number. If the system is effective over time, either at raising revenue or incentivizing more favorable treatment from trading partners, it could eventually have a top tariff rate significantly in excess of 10% that applies to a small number of countries. Similar to the domestic tax code, once the government starts carving out exclusions and deductions for various behaviors, it needs to raise rates to achieve the same revenue goals. Such a system can embody the view that national security and trade are joined at the hip. Trade terms can be a